You hit your stop loss continuously, not because the market is difficult, but because you don't truly understand price action. I mean, 90% of retail traders lose money not because they lack capital, but because they completely misread price behavior. You think you're trading, but look, let's be brutally honest for a second. You are actually just gambling.
Yeah, that is the unforgiving reality of the charts. I mean, every single time you click that mouse, every time you enter a position, you're basically stepping into a gladiator arena.
Right.
And in this arena, your opponents are the smartest, best-funded institutions on the planet. They are actively, methodically hunting your mistakes,
And they're terrifying to think about.
Oh, absolutely. They know your psychology intimately. In fact, they know it way better than you do, and they literally monetize your lack of discipline.
Man, that hits hard right out of the gate. But honestly, it's exactly what we need to confront today. We are pulling from a massive, incredibly dense stack of sources for this deep dive.
Yeah, we've got a lot to cover.
We really do. We're looking at 15 years of forex backtesting data, deep behavioral psychology research papers, and some truly harrowing postmortems from day trading communities. Like real traders breaking down how they lost everything.
The real stories.
The painful ones.
Exactly. And we're channeling the exact mindset of a master forex trader and a 2026 YouTube SEO expert.
Right, which means we have a very specific sort of twofold mission today. First, we are going to completely rebuild your trading framework from the ground up.
I love that.
We're going to deconstruct those bleeding amateur habits and forge an institutional level sniper using price actions, smart money concepts, and elite XAUUSD goal strategies.
And then the second part.
Second, we're going to show you how to turn this highly lucrative knowledge into a million-view financial content empire in the 2026 digital landscape.
Exactly. But before we get into the mechanics of building an empire, we really have to start with survival.
Yeah, you have to survive the market first. Right. So if you're listening to this right now and you have ever felt that immediate sickening feeling of regret right after clicking the buy button because you knew deep down it was an emotional trade and not your system, drop a 1 in the comments down below.
I guarantee there will be a lot of ones.
Oh, thousands. We want to see how many of you are trapped in this cycle. Because when we look at the statistics, the failure rate of retail traders is staggering. And the tragic part, it's almost never a strategy issue, is it?
Almost never. I mean, you can give a losing trader a perfectly back-tested, highly profitable strategy with a proven edge, and they will still manage to blow their account.
Wait, really? Even with a perfect system?
Oh, absolutely. They don't fail because their moving average cross was slightly inefficient. They fail because of deeply ingrained cognitive biases that have evolved in the human brain over millennia.
So it's a fundamental biological breakdown when actual money is on the line?
Precisely. The two most destructive biases in the trading arena are loss aversion and the gambler's fallacy. Let's look at loss aversion first because it's the silent killer of accounts.
Let's do it. What is it exactly?
Scientifically, the pain of losing is mathematically twice as psychologically powerful as the pleasure of gaining. In trading, this manifests as complete paralysis. You just become absolutely incapable of accepting a small, manageable loss.
Yeah, I want to break down exactly what that looks like in real time because I think pretty much everyone listening has been here. You're in a trade, you watch the candles turn red.
The worst feeling.
Right. It hits your predefined stop-loss area. That was the line in the sand you drew when you were calm and logical. But instead of cutting it cleanly like a professional, your brain just it refuses.
It completely rebels.
It refuses to accept the psychological pain of being wrong. The ego screams at you. So what do? You drag your stop loss further down the chart? You hope, you pray.
You have the hope trade.
Exactly. And you let a $50 paper cut turn into a $500 gaping wound. Why does our brain betray us like that?
It's all about brain chemistry. And it's actually terrifying when you realize what's happening. When a trade goes into profit, you get a hit of dopamine. You feel like a total genius.
Because you solved the matrix.
Exactly. But when a trade goes against you, your brain releases cortisol. That's the primary stress hormone. Your body literally reacts as if a predator is chasing you in the jungle.
Wow. Over a red candle.
Yes. Your prefrontal cortex, the part of your brain responsible for logic, mathematics, long-term planning, it just shuts down.
Yeah.
Your amygdala takes over entirely.
The fight or flight center.
Right. And right then, the gambler's fallacy kicks in to quote-unquote save you.
Oh, that's the idea that if I flip a coin and get tails 3 times, the next one basically has to be heads, right?
Yeah.
Even though the odds are still 50-50.
Exactly. It's the irrational belief that past, statistically independent outcomes somehow influence future probabilities.
Yeah.
You lose 3 trades in a row, a rational mind knows the 4th trade still has an independent probability of success.
Right, based on the system's edge.
Yes. But your amygdala, swimming in cortisol, convinces you that the 4th trade simply must be a winner. You feel you are due for a win, like the market owes you.
Which it definitely doesn't.
No, the market doesn't care about you at all. So, to make up for the previous losses quickly, you double your position size, you abandon your risk management protocol entirely.
Which brings us to a really crucial distinction I saw in the research notes. Beginners often confuse overtrading with revenge trading, but they are entirely different beasts, aren't they?
Well, they are completely different. Overtrading is taking suboptimal setups out of boredom. It's feeling like you always need to be in the market to be a real trader.
So it's kind of like a lack of discipline, like mindlessly eating junk food because it's just sitting on the kitchen counter.
That's a perfect way to put it. Revenge trading, however, is a severe emotional hijacking. It's a violent reaction.
So what does that specific anatomy look like? Because I feel like people throw the term revenge trading around without understanding the exact sequence of events.
It almost always starts with a very specific flavor of FOMO. You know, the fear of missing out.
Yeah.
You're watching the chart, you see a massive green candle pushing up, and you jump in late at the very top.
Because you just can't stand watching the market make money without you.
Exactly. Naturally, the market immediately reverses to correct itself. You take a swift, painful loss. Instantly, that FOMO transforms into revenge. You feel cheated. You feel insulted by the market.
Like the market is intentionally mocking you personally.
Yes, it feels deeply, deeply personal. And here is where the trap snaps shut. It's the insidious, I will just get back to break-even mentality.
Oh man, the break-even trap.
Yeah. You're down $300 on the day. Your normal daily goal is $500. Instead of walking away, you start taking absolute garbage setups just to get more at-bats to make that money back.
You just want to see green again.
Right. You re-enter immediately, often in the opposite direction, drastically increasing your lot size. You're no longer trading objective market structure.
What are we trading them?
You're trading your subjective profit and loss statement. You are trying to put a gun to the market's head and force it to give your money back.
And the market always wins that standoff. I mean, looking at some of these Reddit postmortems in our sources is just haunting.
They're devastating to read.
They really are. These aren't just abstract numbers. These are catastrophic emotional failures.
Yeah.
Let's talk about the trader who was up $5,000 on a single position. The market started a massive, undeniable sell-off.
But they didn't get out.
No. Instead of securing profits or even just moving their stop to break even, loss aversion anchored them.
That anchoring bias is deadly. They had already mentally spent that $5,000. In their head, yeah, the new watch was bought, the vacation was booked.
Wow, yeah. They already own the money.
Exactly. So when the market tanked, accepting anything less felt like a physical theft. As it went deep into the red, they actually doubled down.
That's insane.
They bought more to average down, completely paralyzed by hope, until they blew the entire account. Look, I know this feeling intimately.
Really? You've been there.
Early in my career, long before I understood any of this, I wiped out a 6-figure account in 48 hours doing exactly this.
A 6-figure account
No.
in 2 days?
Yes. I was shorting an index, it squeezed higher, and instead of taking a $2,000 loss, my ego decided I was smarter than the global economy.
Oh no.
I kept adding to the short. I kept moving my stop. When the margin call finally hit, I just stared at a blank screen, literally physically shaking.
Wow. That really grounds it. It's not just beginners making these mistakes. It's anyone who lets their guard down.
Anyone.
And speaking of ego, there was another story in the data about a trader who lost $200,000 on a single position. They were trading LU naked puts.
Selling naked options is basically picking up pennies in front of a steamroller.
Right. It went against them, and they were staring at a standard $5,000 loss. They refused to cover. The market gapped down the next morning, and that $5,000 became a $200,000 hole.
It's just brutal.
Yeah.
But the core lesson applies to forex and gold just the same. When you refuse to cut a loss, you are broadcasting to the universe that your ego is more important than your capital.
And the market will happily take your capital.
Exactly. The psychological trauma for that specific trader was so profound, they kept a single share of LU in their account for 20 years as a daily reminder.
A 20-year reminder of what happens when you refuse to submit to the market's reality. That is wild. And then there's the velocity of destruction. Another trader admitted to blowing 46 evaluation accounts in a single month. 46.
That is entering a permanent state of tilt. Blowing an account, instantly purchasing another one out of pure rage to prove they're right, and blowing it again within hours.
It's like a machine gun of bad decisions.
It's a complete biological surrender to the amygdala. Your IQ effectively drops by 20 points in that state.
Yeah.
You are operating on pure primal instinct.
So if willpower is a depleting resource, and we know it scientifically fails after a loss because of this cortisol flood, what is the actual cure? Because clearly writing "I will not revenge trade" on a sticky note doesn't work.
No, sticky notes are useless against biology.
Right. So how do we build a behavioral guardrail to protect us from ourselves?
You have to engineer your environment, because you cannot trust your future self. First, you must establish strict, non-negotiable daily loss limits, a hard monetary figure. If you hit it, the platform closes.
Okay, that makes sense. What's the second step?
Second, you mandate a physical break. After any loss, you physically step away from the screens for 15 minutes. You have to break the visual feedback loop that is feeding the amygdala, let your cortisol drop, walk away.
And the third?
Third, you actively log your emotional triggers. If you are anxious or desperate before clicking buy, you do not execute.
But listen, I have to push back here because this is where theory meets reality. Is trading psychology essentially like a diet?
How do you mean?
Well, everyone on earth knows the rules of a diet. Eat less, walk more. Every trader knows the rules. Use a stop loss, walk away when red. But in the moment of extreme hunger or staring at a massive red P&L, willpower just evaporates.
It does.
A diet fails because the fridge is right there in the kitchen. In trading, the buy button is right there glowing on your desk. We need a physical lock on the fridge, not just a promise to be a better person.
Right. That is a brilliant analogy, and you are absolutely right. A journal entry is completely useless when you're seeing red. Professional traders do not rely on promises. They use software locks.
Software locks? Like what?
They use third-party risk management software that integrates with their broker and literally locks them out of their accounts once their daily drawdown limit is reached.
Wow, so they can't trade even if they want to.
Exactly. It changes their password for 24 hours. You must engineer your environment so that revenge trading is technically, physically impossible. You have to remove the decision-making power from your emotionally compromised self.
Okay, so we've locked the fridge, we've survived the psychological warfare against our own biology, but what exactly are we looking at when we finally sit back down at the chart, calm and collected?
Now we get to the fun part.
Right. How do we read the market's emotions instead of projecting our own? We need to decode the matrix of price action and candlestick psychology. Explain it to me like I know absolutely nothing about trading.
Okay, this is where we transition from gamblers to snipers.
Hmm.
You have to understand that candlesticks are not just arbitrary red and green bars on a black background.
Right, they aren't just pretty shapes.
No, they are the most direct, unfiltered, real-time reflection of mass human fear and mass human greed ever created. When you look at a candlestick, you are looking at a historical record of a violent battle between buyers and sellers.
So let's break down the anatomy of that battle for a complete beginner. Let's use the Al Brooks methodology from our sources. What is actually happening inside a single candle?
Every candle has two primary components, the body and the wicks, which are also known as shadows.
Okay, the thick part and the thin lines.
Exactly. The body, the thick part, represents the distance between the opening price and the closing price. A large body indicates overwhelming strength.
So a huge green candle means what?
If it is a massive green candle, it means buyers took control at the exact microsecond the candle opened and maintained brutal, aggressive buying pressure right up to the very last second before it closed. Sellers were totally routed.
And a really small body.
A small body, like a doji, indicates indecision. It's a truce. The market opened, went up a bit, went down a bit, and closed almost exactly where it started. Neither side won.
But what about the wicks? Because I feel like so many beginners just look at the massive red or green body and completely ignore the thin lines sticking out.
Ignoring the wicks is a fatal error. The wicks are literally the graveyards of failed orders. They are where the true hidden story is told.
Walk me through that. How is a wick formed mechanically?
Say you see a long wick at the top of a candle. What happened in reality was that buyers surged forward, pushing the price aggressively up. But at a specific higher price level, they hit a brick wall.
What kind of wall?
Imagine 10,000 retail buy orders hitting a wall of 100,000 institutional sell limit orders, sitting quietly at that specific price.
The retail buying pressure just gets absorbed instantly.
Instantly. The sellers absorbed every ounce of that buying pressure and then violently rejected the price, pushing it all the way back down before the time period ended.
So it leaves that long line behind.
Right. That upper wick is a visual representation of supply completely overpowering demand. It shows you exactly where the massive sellers are hiding in the dark.
This totally changes how you see specific patterns. Let's take a hammer or a pin bar forming at a key support level.
A classic pattern.
Yeah, to a retail trader, it's just a shape they memorized from a cheat sheet PDF they bought for $5. But to a master, it tells a highly specific, dramatic story of exhaustion, doesn't it?
It absolutely does.
Yeah.
Picture a market grinding down for hours. It hits a major support zone. The new candle opens and sellers aggressively push the price down, trying to break through the floor. The candle is deep, menacingly red.
And the retail guys are panicking.
Exactly. Retail traders see this deep red and start panic selling, convinced the bottom is falling out. But then, institutional buyers, who have been patiently waiting with massive limit orders, step in. They absorb every single sell order. The selling pressure completely exhausts its ammunition.
And then the buyers just hijack the momentum.
Precisely. They hijack it, aggressively pushing the price all the way back up, closing the candle near the open. What remains on your screen is a small body with a massive, long lower wick.
So it's not a magic shape.
Not at all. That pin bar is a bear trap that has just been violently sprung on the late emotional sellers.
Wow. And what about an engulfing candle, where the body of the current candle completely covers the body of the previous one?
An engulfing candle is a total immediate psychological flip. Imagine a slow uptrend, lots of small green candles. Buyers are hesitantly in control.
Just creeping up.
Right. Then suddenly, a massive red candle prints, opening higher but closing so low that its body completely swallows the previous green candle. That is extreme confidence and aggression entering the market from the sellers.
The psychology flips on a dime.
Yes, the psychology of the entire market has flipped 180 degrees in a single time period.
It's like the heartbeat of the market, and that collective heartbeat creates market structure, right? The market breathes. It inhales and exhales in waves, creating higher highs and higher lows in an uptrend.
And lower highs and lower lows in a downtrend.
Yeah.
Yes, that structural heartbeat is your only reliable map.
Break that down a bit more for the beginners.
As long as the market is consistently making higher highs and higher lows, buyers are undeniably in control. Every pullback is just an exhale before the next push.
So you shouldn't panic on a pullback.
Exactly. But when that structure breaks, when a higher low is finally violated and the market makes a lower low, that is the very first objective sign that the psychology has shifted from greed to fear. You cannot ignore a break of structure.
Let's give the listeners an interactive chart exercise right now.
I love this idea.
If you're listening to this, the next time you open your trading platform, I challenge you to change all your candles to a single neutral color like gray. Strip away the emotional triggers of bright red and green completely.
That's a powerful exercise.
Then ask yourself two simple questions when looking at those gray blocks. Who was in control during this candle? And where exactly did they lose that control? Look for the long wicks that show violent rejection. Read the narrative of the battle, not the colors.
That gray candle exercise is the fastest way to transition your mind from a retail gambler looking for magic shapes to a professional tape reader actually understanding order flow.
And hey, if you want us to do a separate, highly detailed video breaking down every single major candle pattern and the institutional psychology behind them, comment below right now.
We can definitely do a deep dive just on that.
But hold on, if reading candles is just reading human emotion, then looking at a 1-minute chart versus a daily chart is like listening to a crowd's sudden panic in a stadium versus studying a nation's long-term geopolitical shift over a decade.
That's a great way to think about it.
Aren't they fundamentally different? I mean, which time frame actually tells the truth?
They both tell the truth, but entirely different types of truth. The 1-minute chart is algorithmic noise. It's the visceral, knee-jerk reaction to news headlines and retail panic. It is highly erratic.
So it's basically chaos.
Pretty much. The daily chart, however, represents the committed, long-term capital of major global institutions. A pin bar on a 1-minute chart might mean a single regional bank executed a market order.
Which doesn't mean much in the grand scheme.
Right. But a pin bar on a daily chart means that the collective financial weight of the global system rejected a specific price level.
So how do you use both?
Master traders use the daily charts to establish the undeniable macroeconomic narrative, and they use the lower time frames simply to precision time their entry into that larger narrative.
Which is the perfect bridge to smart money concepts, or SMC. Because if price action is the heartbeat, SMC is understanding exactly who is controlling the pulse.
Now we're getting to the real secrets.
We have to talk about the puppet masters. The undeniable fact from our sources is that smart money-like central banks and massive hedge funds, they control roughly 70% of all forex volume.
70%, let that sink in.
And they don't trade using RSI indicators or simple trend lines. They actively hunt the people who do.
To truly understand SMC, you have to fundamentally understand how liquidity works at an institutional scale. Institutions don't trade in lots of 10 or 20. They trade in thousands of standard lots. If a massive hedge fund wants to buy $100 million worth of gold, they cannot simply click buy at the current market price on their terminal.
Because there wouldn't be enough people selling at that exact microsecond to fill their order, right?
Exactly. If they tried, their own massive buying pressure would eat through all the available sell orders instantly, shooting the price up exponentially before their order was fully filled. They would get a terrible average entry price.
That's what they call slippage, right?
Yes. To avoid slippage, they need immense liquidity. They need a massive, predictable, concentrated pool of sellers to absorb their massive buy order, and the easiest place to find that pool.
Retail stop losses.
Retail stop losses.
Oh, wait.
Every single time.
This brings us to the trap of inducement. I loved this analogy in the research. Inducement is essentially putting a giant piece of cheese on a mousetrap.
It's exactly that.
The institutions have the capital required to push the price around in the short term. So they will intentionally push the price to create a quote-unquote perfect support level, a beautiful, clean, triple bottom that you see in every beginner YouTube tutorial.
It looks too good to be true.
Right. They are intentionally tempting retail traders to place their buy orders there, and more importantly, they are tempting them to place their stop losses just below that obvious support line.
That is the grand manipulation. Think about what a stop loss actually is mechanically. When retail traders buy at that support, their stop loss is technically a pending automatic order to sell at a lower price.
Oh, wow.
So, just below that obvious support line, a massive pool of automatic sell orders begins to accumulate. That is sell-side liquidity. Once enough cheese is on the trap, the institutions execute.
What do?
They push the price aggressively down, boarding right through that perfect support line.
Violently triggering all those retail stop losses.
Yes. The retail traders are automatically forced to sell to loss, and the institutions are sitting right there at that lower price with their massive buy limit orders, absorbing all those retail sell orders.
So they just feast on the retail panic.
Exactly. They perfectly fill their massive long position without any slippage. This is the infamous stop hunt. As soon as their orders are filled, they snap the price back up into the real intended macro trend.
And the retail trader is left slamming their desk, screaming, "I knew it was going to go up. It just hit my stop loss to the pip and then reversed without me. The market is rigged."
Well, yeah, it is rigged, but it didn't happen by accident.
You were the designated exit liquidity for the institution's entry. So how do we stop being the prey? Moving hundreds of millions of dollars has to leave footprints on the chart.
It leaves distinct algorithmic signatures. The first major footprint is the order block, or OB.
Explain the order block.
An order block is typically the final candle before a massive institutional push that breaks structure. If institutions manipulate the price down to accumulate a long position, that final down candle before the explosive up move is the bullish order block.
That is where their footprint was stamped.
Exactly, that's where they initiated their massive buys.
And then there's a fair value gap, the FVG. I hear this term everywhere, but let's mechanically explain why it works. The research notes call it an imbalance.
When smart money moves the price violently and rapidly away from an area, it leaves literal gaps in the order flow ledger. The price jumps so fast that buyers and sellers didn't have a chance to properly interact at those intermediate price levels.
It's like a vacuum.
Yes, a vacuum.
Right.
The algorithmic pricing models used by market makers are mathematically designed to be efficient. These fair value gaps act like powerful magnetic forces, because the market algorithms will almost always force the price to return to these gaps at a later time.
To fill the gap.
To fill the inefficiency and balance the books before continuing the main trend.
And structurally, we look for the BOS, break of structure, and COCH, change of character. Let's define COCH.
A change of character is that subtle moment an internal high or low is broken, signaling the institutional tide might be turning. It's the early warning system.
So hold on, you're telling me the banks intentionally draw the textbook support lines just to trick me, Traditional retail traders are basically playing checkers, drawing little diagonal trend lines, while smart money is playing 4D chess, intentionally creating those patterns just to use retail as liquidity.
That is the most devastatingly accurate way to describe the dynamic. Retail is trading the geometric pattern. Smart money is trading the predictable psychology of the people trading the geometric pattern.
That is mind-blowing. So how do we spot this on a live chart? Like, what's a practical guide for the listeners right now?
Look for obvious swing highs or lows that look too perfect. If a support level has been touched 3 times and looks completely impenetrable, it is almost certainly a manufactured trap. Do not buy that support.
Don't take the cheese.
Never take the cheese. You wait for the trap to spring, and then you follow the trapper.
So you wait for the price to intentionally break the support, sweep the liquidity, form a clear change of character to the upside, indicating the institutions have stepped in, and then you enter your long position on the pullback into the fair value gap.
Exactly. You must patiently wait for the manipulation to happen before you participate.
Incredible. Now let's take all of this high-level institutional theory and apply it to the ultimate beast, trading XAUUSD or gold in 2026.
Oh, gold is a completely different animal now.
Why gold? Because the data shows that in 2026, gold has completely transformed. It is no longer a sleepy, safe haven asset your grandfather keeps in a vault.
Not even close.
It is a highly volatile, untamed monster trading well over $5,000 an ounce, with massive daily ranges of $150 to $200. That's a 3 to 4% intraday move on a physical commodity.
The structural changes in global finance have weaponized gold's volatility. It reacts violently to sudden inflation data prints, interest rate decisions, and escalating geopolitical tension. When inflation runs hot, capital floods into gold.
So to trade this beast effectively, timing has to be everything.
Timing is everything. The absolute best times to trade, where the volume is thick enough to respect smart money concepts rather than just thrashing around randomly, are the London session, the New York session, and specifically the overlap hours between London and New York.
Why the overlap?
That is when institutional volume is at its absolute peak and the manipulation and trend runs are the cleanest.
So what is the real combat strategy here? How do we extract profit from a $200 daily range without getting our faces ripped off?
We combine SMC with classic macro trend following, because despite its volatility, gold trends heavily. You use higher time frame moving averages on the daily or 4-hour chart to establish the undeniable macroeconomic trend.
So if the daily chart says we're going up, we only look for buy setups.
If the macro trend is up, you are only looking for longs, period. You wait for the intraday pullbacks. You wait for the London session to create a fake move down in. An inducement that sweeps the retail liquidity built up during the Asian session.
Oh, so they trap the Asian session traders.
Always. You wait for it to hit an institutional order block and create a fair value gap on the 15-minute chart. That is your precision entry point. You ride the macro trend, but enter with a micro precision of SMC.
But with daily ranges, this massive trading place, gold sounds like trying to ride a mechanical bull on steroids. If you don't have perfect risk management, isn't gold the fastest way to experience that $200,000 loss we talked about earlier?
It is a financial incinerator for the undisciplined. Slippage alone on a volatile gold spike could easily bypass a careless stop loss. This brings us to the most critical rule of the master trader, the 3-5-7 risk management rule.
Okay, let's write this down. What is the 3-5-7 rule?
This rule separates long careers from blown accounts. 3% risk per trade maximum.
Okay, 3%.
This means the absolute distance from your entry price to your hard stop loss, multiplied by your lot size, can never equal more than 3% of your total account equity.
Got it. What's 5?
5% total market exposure across all open trades. You can't have 5 trades open, all risking 3%. That's 15% risk. Too high.
Makes sense. And the 7?
You are aiming for a 7% consistent monthly profit growth.
7% a month. You're not trying to double your account in a week like a degenerate gambler.
Yeah.
You're systematically compounding wealth.
Exactly. Leverage amplifies everything on gold. If it moves 3% against you in a single day, and you are heavily leveraged without a hard stop, your broker will margin call and liquidate you before you even have time to panic. It requires the emotional detachment of a surgeon.
That is the harsh truth. Look, if you are listening to this right now, I want you to be totally honest with yourself. Are you currently trading based on pure emotion, letting losers run, or do you have a strict mathematical system like the 3-5-7 rule? Comment down below. We want to hear from you.
Transparency is the first step. to fixing the problem.
And if you want us to do a live screen share breakdown of a real XAUUSD chart using these exact smart money concept principles, comment XAUUSD. If we get enough, we'll absolutely do it.
I'd love to break down a live chart.
Awesome. Now, let's pivot to the final piece of the puzzle. We've given you the knowledge to extract money from the global financial markets. Now we are going to show you how to multiply that knowledge by packaging it for the 2026 digital content landscape.
This is where you build the empire.
Financial content is almost absurdly lucrative. When we look at the back-end analytics of YouTube and TikTok, finance video RPMs, which is revenue per mil, what advertisers pay creators per 1,000 views, sit around $12 to $22.
Huge.
Compare that to the gaming niche, which sits around a mere $3. Advertisers pay a massive premium for viewers actively interested in wealth generation.
The direct monetization potential is unparalleled.
Yeah.
But you are not just competing against other human creators, you are competing against the most sophisticated AI neural networks in the world.
The algorithm.
The 2026 algorithm reality is governed entirely by a concept called retention engineering. Platforms no longer care just about catchy clickbait thumbnails. They care about viewer satisfaction and average view duration.
Let's unpack that jargon for a second. Why does the AI care more about average view duration than someone just clicking the video?
Because the platform's only goal is to keep users on the app as long as possible to serve them more ads. If someone clicks your video and leaves after 10 seconds, that tells the algorithm your content is deceptive or boring.
It hurts their bottom line.
Right. The 70-30 rule dictates that 70% of all views now come from algorithmic recommendations, like the homepage or the suggested feed nut from active search. If your video cannot hold a viewer's attention past the first 30 seconds, the AI will bury it instantly, no matter how good your tags are.
So how do we find an audience if we are starting a channel from scratch today? You can't just make a generic video titled How to Trade Forexes.
That is algorithmic suicide. You will be drowned out by massive, established channels. Instead, you find low-competition micro-niches.
How do you find those?
You use native platform tools like Creator Search Insights on TikTok. You look for content gaps, highly specific queries with high search volume, but a severely low supply of quality videos.
Give me an example.
Instead of how to trade, you target a hyper-specific pain point. SMC inducement explained on XAUUSD 2026.
Oh, so you're capturing a smaller but deeply engaged, high-intent audience.
Exactly. Once you find that gap, you must structure the video perfectly. Let's break down the precise anatomy of a million-view finance video in 2026, the viral video structure formula.
Break it down.
It starts with the first 0 to 3 seconds, the hook. You must hit the viewer's pain point immediately. No intro logos, no theme music.
Just boom, right into it.
Right. You open by saying, this is exactly why your stop loss always gets hunted right before the market goes in your direction. You validate their frustration instantly. Then, seconds 3 to 10. Context. Establish the setup rapidly. Yesterday, during the New York session, gold created a textbook liquidity trap that wiped out thousands of retail traders.
Then we get to the meat of the video.
Yes, seconds 10 to 40. The meat. The high-value teaching. But you can't just show a static, boring chart.
Why not? The information is good.
Because of the psychological rule of retention engineering. You must change the visual stimulus every 90 seconds on YouTube, or every 3 to 5 seconds on short-form content.
Just to keep their eyes glued to the screen.
Exactly. Use dynamic text overlays, colored boxes drawing out the order blocks, animated arrows pointing to the fair value gaps. You must physically reset the viewer's brain to prevent scroll fatigue.
Then, seconds 40 to 50, the payoff. Show the tangible result. By waiting for the liquidity sweep, we caught a 200-pip move with near-zero drawdown. Here is the proof.
And finally, the end. An organic call to action that feeds the algorithm's engagement metrics. Tell them to comment or subscribe based on a specific prompt.
It is a meticulously designed machine to satisfy both the human desire for actionable knowledge and the algorithm's relentless demand for retention signals.
It really is.
So let me synthesize this because it's a profound shift. SEO in 2026 isn't about stuffing keywords into a description box. It's psychological SEO.
Very much so.
You are optimizing for the deteriorating human attention span, using pattern interrupts and emotional hooks in exactly the same way smart money uses inducement to trap retail traders.
Yeah.
You're trapping their attention.
That is exactly it. You manage their attention just as rigorously and methodically as you manage your trading risk. The principles of human psychology govern both the financial markets and the attention economy.
Okay, let's unpack everything we've covered on this incredible journey today. We started by confronting the bloody reality of trading psychology.
The hardest part.
Right. Recognizing that revenge trading is a biological amygdala hijack that requires strict physical software locks and hard daily loss limits to cure. We decoded the matrix of price action, learning to read mass fear and greed through the specific anatomy of candlestick wicks and market structure.
We then elevated that technical understanding by learning to track the puppet masters using smart money concepts, identifying exactly how massive institutions use inducement and liquidity sweeps to trap retail traders to fill their own orders without slippage.
We applied this lethal framework to XAUUSD in 2026, establishing the vital 357 risk management rule to survive gold's unprecedented volatility.
And finally, we decoded the 2026 content algorithm, showing you how to engineer retention, target micro niches, and structure videos to build a lucrative financial content empire.
Both arenas require a deep, unflinching understanding of human psychology, systemic behavior, and the discipline to execute a proven edge consistently.
Absolutely.
Which brings us to a final provocative thought for you to carry with you long after this deep dive ends. The financial market is not a casino. It is nothing more than a giant, unforgiving mirror reflecting mass human psychology in real time.
I love that. A mirror.
The next time you sit down in front of the charts, feeling your pulse quicken as a trade goes red, ask yourself a brutally honest question. Are you actually reading the structural flaws in the market, or are you just staring blindly at your own emotional flaws reflected back at you?
That is the ultimate question every master trader must answer before they can achieve true consistency.
If you got value out of this, make sure to subscribe, leave your comments based on the prompts we gave you earlier to let us know where you are in your journey, and thank you for stepping into the mind of a master trader. See you in the next deep dive.